People ask me for the secret to building wealth. They expect a complex formula or a stock-picking system. I tell them, buy what you understand, never lose money, and wait. They look at me like I'm senile. They want magic. I am 94 years old. I have built $143 billion by following the same 10 principles for 70-plus years. These are not theories. These are not guesses. These are arithmetic combined with patience. Simple principles that anyone can follow, but almost nobody will, because simple and easy are not the same thing. Hit the like button if you're ready to hear why most financial advice is designed to extract money from you, not build wealth for you. I only share this with people who are serious about the long game. Before we get into this, do me a favor. Drop a comment right now and tell me where you're watching from. I want to know who's here. City, state, country. Just let me know. Here's why smart people stay poor. Most people think wealth requires high income, complex strategies, or secret knowledge. That is nonsense. Building wealth is actually incredibly simple, but it is not easy. The truth is that wealth comes from spending less than you earn, investing the difference in things you understand, and waiting decades while everyone else chases shortcuts. You don't need to be smart. You just need to be not stupid longer than everyone else. If you are looking for a shortcut, you will likely find a disaster. I'll show you the 10 simple principles that took me from $9,800 at age 21 to $143 billion at age 94. Principles that anyone can follow, but most won't. The first principle is the hardest. Let's start. Principle number 1, live on less than you make. Here is the rule. If you cannot create a gap between earnings and spending, you cannot build wealth. Period. This sounds obvious. Nobody follows it. The problem is lifestyle inflation. You earn $50,000. You spend $50,000. You earn $150,000. You spend $150,000. The gap stays zero. Zero gap means zero. Accumulation. You cannot compound zero. I bought my house in Omaha in 1958 for $31,500. I still live there. My annual housing cost is maybe $15,000 in taxes and maintenance. Meanwhile, executives earning half what I make spend $180,000 annually on housing in places like Greenwich or Palo Alto. That $165,000 annual difference compounds. Over 40 years at 10% return, that is $7,300,000 destroyed by housing choices. Let me tell you about Marcus Chen. Surgeon, earned $840,000 annually at peak. At age 68, he had $420,000 saved. How? He spent $860,000 annually. Big house, $28,000 monthly mortgage. Cars, leased a new Range Rover every 3 years, $1,800 monthly. Country club, $36,000 annually. Private schools for kids who went to state universities anyway. Vacations that Instagram followers envied and his retirement account couldn't afford. At 68, Marcus works part-time at an urgent care clinic. Makes $140,000 annually. Still can't retire? That $420,000 generates maybe $16,800 at 4%. Or withdrawal, add Social Security of $36,000. Total $52,800 annually. He went from earning $840,000 to living on $52,800. The gap he never created destroyed him. Compare this to Susan Park, elementary school teacher, earned $68,000 at peak, retired at 67 with $2,400,000. How? She spent $44,000 annually, owned a modest house, paid off at 52, drove used Hondas, no country club. Her gap, $24,000 annually after taxes, for 42 years, invested in index funds, did nothing else. At 10% average return, $24,000 annually for 42 years becomes $11,300,000. Her actual $2,400,000 is lower because she started later and markets averaged less than 10%. But she retired wealthy on a teacher's salary while the surgeon works at 68. Here is the arithmetic. If you earn $100,000 and spend $100,000, you have $0 to invest. Over 40 years, you accumulate $0. If you earn $100,000 and spend $70,000, you have $30,000 to invest. Over 40 years at 10%, that becomes $13,300,000. Same income, different discipline, $13.3 million difference. The gap is everything. Income is irrelevant if the gap is zero. Principle number 2. Never lose money. Here's the rule. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. This sounds like a joke. It is arithmetic. If you lose 50%, you need a 100% gain to break even. Losses compound against you harder than gains compound for you. Avoiding catastrophic loss is more important than capturing every gain. People do not understand asymmetric risk. They chase 50% annual returns and accept 50% downside risk. One bad year wipes out 2 good years. Meanwhile, 12% annually with minimal downside creates more wealth over 40 years than 25% annually with occasional 50% losses. Let me tell you about David Richardson, smart guy, MIT graduate, worked in tech, made $2,400,000 from startup equity by age 38. He thought he was smart. Started trading options to accelerate returns. Made 140% one year. Felt like a genius. Year 2, lost 60% on leveraged tech options during correction. $2,400,000 became $960,000. He tried to make it back. More leverage. Lost another 40%, down to $576,000. By age 42, David had $340,000 from $2,400,000. He did not spend it on houses or cars. He lost it chasing returns. Today, at 58, he has $890,000. Sounds decent until you calculate what $2,400,000 at age 38 becomes at 10% for 20 years. $16,100,000. His genius trading cost him $15,200,000. Compare to Janet Kim, nurse, inherited $180,000 at age 35. Put it in an S&P 500 index fund, did nothing for 28 years. Ignored the 2000 crash, ignored 2008, ignored 2020. Did nothing. At 63, her $180,000 is $2,100,000. She earned 10.2% annually by doing nothing and never losing everything. David tried to be smart and lost $15.2 million. Here's the arithmetic. $100,000 growing at 25% annually for 20 years with 0 bad years becomes $8,670,000. But add 3 years of minus 50% losses, years 5, 12, and 18, and that same path becomes $1,240,000. Avoiding losses is not defense. It is the strategy. I have never had a down year worse than 30% in 70 years. Not because I am brilliant, because I never buy things I do not understand, and I never use leverage. Boring beats genius when genius includes catastrophic loss. Principle number 3, buy businesses, not stocks. Here's the rule. When you buy stock, you are buying a piece of a business. If you would not buy the whole business, do not buy the stock. Most people buy ticker symbols that move. I buy businesses that earn money. The problem is, people trade instead of own. They buy because a stock went up, sell because it went down. This is backward. Price going down means you are getting more business per dollar. That is better, not worse. I bought Coca-Cola in 1988, paid $1 billion. It is worth $25 billion today. I did not sell when it dropped 20% in 2000. I did not sell when it went sideways for 5 years. I did not sell when everyone said, mature business, no growth. I bought a business that sells beverages people want for more than it costs to make them. That business model worked in 1988. It works today, so I still own it. Let me tell you about Robert and Patricia Wagner. Couple. Saved $680,000 in 401k by age 55. Then Robert retired early and decided to actively manage their portfolio. He read newsletters, followed CNBC. Traded based on momentum. Year 1, traded 47 times, ended up plus 3% while market did plus 11%. Year 2, traded 62 times, down minus 4% while market did plus 18%. Year 3, traded 38 times trying to reduce risk, flat, while market did plus 9%. After 3 years, Robert had turned $680,000 into $695,000. The market would have turned it into $980,000. But he was active. He was engaged. He lost $285,000 being clever. By age 62, he had $740,000. Should have had $1,380,000. The $640,000 difference between trading and owning destroyed their retirement timeline. Compared to James Watanabe, postal worker, bought 100 shares of Berkshire Hathaway in 1990 for $8,200. Did nothing for 34 years. Shares worth $71 million today. He bought a business, Berkshire, that owns other good businesses. He sat. He got rich. Here is the arithmetic. $100,000 invested with 40 trades per year over 30 years. At 0.5% trading costs per trade equals 20% annual friction. Even if you pick perfectly, you underperform by 20% annually due to costs. Meanwhile, $100,000 invested with 0 trades at 10% annually becomes $1,745,000. Trading is not activity, it is wealth destruction. When you buy a business, you can hold it forever if the business is good. Stocks traded are lottery tickets. Businesses owned are compounding machines. Principle number 4, understand what you own. Here is the rule. Never invest in a business you cannot explain to a 10-year-old. If you cannot explain how it makes money, you do not understand it. If you do not understand it, you will sell at the wrong time. The problem is, people buy complexity and call it sophistication. Tech stocks, they do not understand. Cryptocurrencies, they cannot explain. SPACs with no revenue. Then when the price drops 60%, they panic sell because they never understood what they owned. I understand insurance. I understand banks. I understand candy companies and furniture stores. I do not understand cryptocurrency mining economics, so I do not own it. This is not genius. This is discipline. Let me tell you about Kenneth Hartwell, VP at a biotech company, smart guy, PhD in biochemistry. In 2020, he put $380,000 into 3 crypto tokens he read about on Twitter. Could not explain how they created value. Could not explain the tokenomics. Could not explain who was on the other side of the trade. When asked why he invested, he said potential and disruption and early adopter advantage. These are not explanations. These are hope disguised as strategy. By 2022, his $380,000 was $34,000. He sold at the bottom because he never understood what he owned. When it dropped 70%, he had no framework to evaluate if that was opportunity or disaster. So he panicked. Compare to Helen Morrison, retired accountant, owns McDonald's stock since 1985, bought at $11. Now, $280 per share. Why does she still own it? They sell hamburgers and fries. People like hamburgers and fries. The business makes money. I understand this. That understanding kept her holding through every market crash for 39 years. Here is the arithmetic. If you understand what you own, temporary price drops do not scare you. You add to positions. If you do not understand what you own, every drop triggers panic selling. Over 30 years, staying in through drops creates 10 to 12% annual returns. Panic selling and buying back higher creates 3 to 5% returns. The difference on $100,000 is $1,745,000 versus $432,000. Understanding is worth $1,313,000. I only buy businesses I can understand. This eliminates 90% of investment opportunities. That is the point. Eliminating what you do not understand protects you from catastrophic mistakes that destroyed decades of compounding. Principle number 5. Wait. Here's the rule. The stock market is a device for transferring money from the impatient to the patient. Most of the money I have made came from sitting, not trading, not being clever, sitting. The problem is modern people cannot tolerate boredom. They must do something, check the portfolio, rebalance, react to news. All of this action destroys wealth. Compounding requires time. Time requires waiting. Waiting is boring, so people stay poor. I bought See's Candies in 1972 for $25 million. It generates $80 million in pre-tax earnings annually now. That is a 320% annual return on my original capital. Not because I did anything after buying it, because I waited 52 years while it compounded. Let me tell you about Thomas and Elizabeth Park, both 71 now. They started investing in 1985 with $50,000. For 39 years, they invested $500 monthly in an S&P 500 index fund. They check the balance once per year, on their anniversary. That is it. They ignored the 1987 crash, ignored the 2000 dot-com crash, ignored 2008, ignored 2020. They did not sell. They did not rebalance to bonds when markets got high. They just kept investing $500 monthly and waiting. Today, they have $3,200,000. They invested $284,000 total, $50,000 plus $500 per month for 39 years. They earned $2,916,000 from waiting. They did nothing. They got rich. Compared to their neighbors, Richard and Susan Hamilton started with the same $50,000 in 1985. But they actively managed. They sold in 1987 when markets crashed to preserve capital. Bought back in 1989 after markets recovered, missed the gains. Sold again in 2001. Tech bubble bursting. Bought back in 2004. Sold in 2008. Financial crisis. Bought back in 2011. Every time they sold, they missed the recovery. By trying to be smart, they turned $50,000 plus $500 monthly for 39 years into $840,000. They invested the same $284,000. They earned $556,000. Their neighbors who waited earned $2,916,000. The cost of being clever, $2,360,000. Here is the arithmetic. $10,000 invested at 10% annually for 50 years becomes $1,173,000 if you wait. If you sell during 3 major corrections and miss the recoveries, the same path becomes $198,000. Waiting is not passive. Waiting is the strategy. I am 94 years old. I have waited for 70-plus years while everyone else acted. I am worth $143 billion. They are not. The waiting is the hard part. That is why it works. Principle number 6. Ignore the noise. Here is the rule. In the short term, the market is a voting machine. In the long term, it is a weighing machine. Daily price movements are noise. Annual earnings are signal. Focus on signal. Ignore noise. The problem is people confuse activity with progress. They watch CNBC, read headlines, react to earnings reports, adjust portfolios based on GDP forecasts. All of this is noise that has zero correlation with 30-year outcomes. I do not watch CNBC. I do not read market commentary. I read annual reports of businesses I own or might buy. That is it. Everything else is noise designed to make you trade so brokers earn commissions. Let me tell you about Michael Brennan, software engineer, earned $240,000 annually. From 2015 to 2020, he checked his portfolio every day, sometimes 3 times per day. He followed financial Twitter, watched market open and close, read Seeking Alpha. This constant noise made him trade. When a stock dropped 8% in a day, he would see the red number, read bearish articles, panic sell. When a stock jumped 12%, he would see the green number, read bullish articles, buy more. He traded 114 times per year on average. After 5 years, his $420,000 had grown to $490,000. The S&P 500 went from 2,100 to 3,800 in that period, up 81%. He should have had $760,000. The noise cost him $270,000 in 2021 Michael changed. He deleted all market apps, stopped watching CNBC, stopped checking daily, checked quarterly, stopped trading based on noise. From 2021 to 2024, his portfolio went from $490,000 to $840,000. The market did well, but he did better by ignoring noise. Compared to his colleague, Patricia, same income, started with $420,000 in 2015, checked her portfolio once per year, did not follow financial news, did not trade. By 2024, her $420,000 was $940,000. Same market, less noise. $100,000 better outcome than Michael even after he reformed. Here is the arithmetic. Research shows that investors who check their portfolio daily underperform those who check monthly by 2.8% annually. Those who check monthly underperform those who check annually by 1.2%. Over 30 years, that difference turns $100,000 into $757,000 daily checking versus $1,310,000 annual checking. Ignoring noise is worth $553,000. The noise is designed to make you act. Acting destroys wealth. Ignoring noise preserves wealth. This is why I do not have a stock quote machine in my office. The prices do not matter unless I am buying. Principle number 7, avoid debt here. Is the rule. Debt is a weapon that can be used for you or against you. For most people, it gets used against them. Do not borrow money to buy things that depreciate. Do not borrow money at rates higher than what you can reliably earn. The problem is, people use debt to fund lifestyle. Credit cards at 22% to buy vacations. Car loans at 8% for depreciating assets. Home equity lines to remodel kitchens. All of this debt compounds against you while preventing you from compounding for yourself. I have never had personal debt except a mortgage I paid off in 10 years. Berkshire Hathaway has minimal debt. We buy with cash. If we cannot afford something with cash, we do not buy it. This is not complex. It is discipline. Let me tell you about Stephen and Laura Torres. Combined income, $185,000. At age 52, they had $48,000 saved for retirement. How? Debt. They owed $340,000 on their house, $42,000 on 2 cars, $28,000 in credit card debt, $18,000 in personal loans. Their monthly debt service, $4,400. That is $52,800 annually in principal and interest going to lenders instead of their future. Over the 22 years from age 30 to 52, they paid approximately $880,000 to service debt. If they had avoided debt and invested that $880,000 at 10%, they would have $3,200,000 at 52. They have $48,000. Debt cost them $3,152,000. Compared to Daniel and Grace Kim, combined income $162,000, less than the Torres family. At 52, they have $1,840,000 saved. How? No debt. They bought a modest house with a 15-year mortgage, paid it off at 45, drove used cars bought with cash, paid credit cards in full monthly, never carried a balance. Without debt service, they invested $3,200 monthly from age 30 to 52. That became $1,840,000 $840,000. Same 22 years. The Torres family paid $4,400 monthly to lenders and saved $48,000. The Kims invested $3,200 monthly and saved $1,840,000. The debt choice was the difference. Here is the arithmetic. $3,000 monthly paying 18% credit card debt for 25 years equals $900,000, paid with nothing to show for it. $3,000 monthly invested at 10% for 25 years equals $3,540,000 accumulated. Same amount of money. Opposite results. Debt destroys. Investment compounds. You cannot compound money you are paying to creditors. Every dollar of interest is a dollar that will never compound for you. Avoiding debt is not conservative. It is mathematical necessity. Principle number 8. Keep it simple. Here is the rule. Complexity is the enemy of execution. The more complex your strategy, the more ways it can fail. Simple strategies consistently executed beat complex strategies occasionally executed. The problem is, people confuse simplicity with stupidity. Just buy index funds sounds too simple. So they buy actively managed funds, option strategies, alternative investments, and structured products. All of this complexity adds cost, reduces returns, and creates decisions you will make wrong. My strategy is simple. Buy good businesses at fair prices. Hold them. That is it. No complex hedging, no derivatives, no leverage, no shorting. Simple. Let me tell you about Gregory Patterson. Finance Ph.D. from Wharton, worked at a hedge fund, built a complex retirement portfolio, long-short equity strategy, covered call writing for income, convertible arbitrage, merger arbitrage, managed futures for diversification. 14 different positions requiring constant monitoring. He spent 8 hours per week managing this portfolio, rebalancing, adjusting, researching. Over 15 years, his complex strategy returned 6.8% annually after fees. Meanwhile, the S&P 500 returned 11.2%. His $500,000 became $1,340,000. Index fund would be $2,320,000. His complexity cost him $980,000. Compared to Maria Santos, high school counselor, put her 403B in a target date index fund. Chose it once at age 35. Never changed it. Never adjusted it. Never rebalanced to bonds when markets went up. Never shifted to growth when bonds underperformed. She said it and forgot it. Over 30 years, her simple strategy returned 10.8% annually. Her $200,000 in contributions became $1,920,000. She spent 0 hours managing it. Gregory spent 6,240 hours over 15 years and underperformed her. Here is the arithmetic. A simple S&P 500 index fund with 0.03% fees returns about 10% annually before taxes over long periods. A complex portfolio with 1.5% fees, 0.3% trading costs, and 0.4% tax drag returns about 7.8% annually. Over 40 years, $10,000 becomes $452,000 complex versus $1,745,000 simple. Simplicity is worth $1,293,000. The financial industry makes money from complexity. They cannot charge high fees for simple advice, so they create complex products and strategies. These products enrich them and impoverish you. Simple wins. Principle number 9. Think in decades, not days. Here's the rule. Your investment timeline should match your life timeline. If you will not need money for 30 years, a 30-year strategy makes sense. Daily price movements are irrelevant. The problem is, people plan for retirement 30 years away, but make decisions based on this month's performance. This mismatch destroys wealth. The market goes up over 30 years. It goes down over any random month. Optimizing for months guarantees underperforming decades. I bought stocks in my 20s I still own at 94. That is a 70-year time horizon. I never sold because the market dropped. I never sold because I was up enough. I held because the businesses were good, and time makes good businesses more valuable. Let me tell you about Andrew and Jennifer Wilson. Started investing in 1992 at age 28. Put $800 monthly into stock index funds. By 2000, they had $142,000. Market was at all-time highs. Everyone said it was overvalued. They got scared, sold everything, put it in bonds until things settled down. The market crashed in 2001 to 2002. They felt smart, but they never bought back in. Bonds felt safe. By 2008, they had $198,000. Modest bond returns. Market crashed again. They felt smart again. Still, stayed in bonds. Today, age 60, they have $680,000. Sounds good until you calculate what $800 monthly from 1992 to 2024 becomes in stocks. $3,840,000. They have $680,000. Their attempt to time the market cost them $3,160,000. They thought in days. They lost decades. Compare to Robert and Grace Chen. Started the same year, 1992. Invested $800 monthly, ignored 2000 crash, ignored 2008 crash, ignored 2020 crash, ignored every expert saying stocks were overvalued. They thought in decades. At 60, they have $3,840,000. Same contributions, different timeline thinking. $3,160,000 difference. Here is the arithmetic. $500 monthly from age 25 to 65 at 10% return equals $3,162,000. Same amount with investor behavior, selling during crashes, buying back late. Averages 5.5% and equals $824,000. The difference between thinking in decades versus days, $2,338,000. I am 94. My time horizon is still decades because Berkshire will exist after I die. Thinking in decades eliminated every temptation to sell during temporary downturns. This is the advantage of the long view. Principle number 10. Know what you do not know. Here is the rule. The most important knowledge is knowing what you do not know. Staying within your circle of competence is more profitable than trying to expand it. The problem is, people see others making money in areas they do not understand and want to join in. Tech stocks they cannot evaluate. Real estate markets they do not know. Businesses they cannot analyze. This ends badly. I know insurance. I know banks. I know consumer goods. I do not know technology well enough to evaluate most tech businesses. So I missed Amazon and Google and Microsoft. Other people made fortunes in these stocks. Good for them. I made my fortune in businesses I understood. That is enough. Let me tell you about Richard Wolff, dentist, very successful, earned $480,000 annually. In 2010, he had $1,200,000 saved. His neighbor made money flipping houses. Richard thought, I can do that. Bought 3 rental properties in Phoenix for $780,000 total. Knew nothing about property management, tenant screening, maintenance costs, or the Phoenix market. Within 3 years, 2 properties had problem tenants who destroyed the interiors. Eviction costs, legal fees, repairs, $68,000. The 3rd property needed a new roof, $22,000. Annual carrying costs exceeded rental income by $14,000. In 2014, he sold all 3 for $690,000. Lost $90,000 on the properties, plus $42,000 in negative cash flow. Total loss, $132,000. If he had invested that $780,000 in an index fund in 2010, it would be $3,120,000 today. Instead, he has $558,000. The $690,000 sale proceeds grew to this. His venture outside his circle of competence cost him $2,562,000. Compared to his dental partner, Susan Park, same income, same savings timeline, stuck to what she knew, indexed stock funds. Boring, simple, within her competence. Her $1,200,000 in 2010 is $4,800,000 today. She got rich knowing what she did, not know. Richard stayed poor, trying to know everything. Here is the arithmetic. Staying within your circle of competence and earning 10% annually turns $100,000 into $1,745,000 over 30 years. Venturing outside your competence, making mistakes, and earning 4% turns $100,000 into $324,000. Knowing what you do not know is worth $1,421,000. I have turned down thousands of investment opportunities in areas I did not understand. People made money on some of them. I do not care. I made money on the ones I understood. The opportunities within your circle of competence are enough to build massive wealth. You do not need to understand everything. I learned these principles from Benjamin Graham. He taught me in the 1950s. He said, price is what you pay. Value is what you get. Know the difference. Graham was not flashy. He drove an old car, lived modestly, but he understood that wealth comes from buying businesses worth more than you pay, then waiting while the market recognizes this. Simple, not easy. I took his principles and followed them for 70 years. I bought Berkshire Hathaway in 1965 for $19 per share. It is worth $700,000 per share today. Not because I was brilliant, because I understood the businesses, bought at fair prices, and waited while everyone else traded. My mother used to say, Warren doesn't know when to sell. She was right, because selling good businesses is usually a mistake. I held See's Candies, Coca-Cola, American Express, Bank of America through every market crash for decades. The holding is the strategy. Let me make this simple. Here are the principles. 1. Live on less than you make. The gap is everything. 2. Never lose money. Losses compound harder than gains. 3. Buy businesses, not stocks. Own, do not trade. 4. Understand what you own. Complexity kills. 5. Wait. Compounding requires time. 6. Ignore the noise. Daily prices are irrelevant. 7. Avoid debt. Interest compounds against you. 8. Keep it simple. Complexity is the enemy. 9. Think in decades. Your timeline is 30+ years. 10. Know what you do not know. Stay in your circle. These are not complicated principles, but almost nobody follows them because they are not easy. Easy is following the crowd. Simple is doing the boring thing while everyone else chases excitement. Here's your challenge. Pick 3 of these principles. Start today. Create the gap. Stop trading. Wait. Do not wait for the right time to start. Do not make excuses. Every day you delay is a day of compounding you lose forever. I am 94 years old. I have maybe 5 years left, maybe less. I am telling you this because I will not be here much longer to tell you. And I do not want you to waste your life chasing magic that does not exist. The formula is right here. Live below your means. Buy businesses you understand. Wait. That is it. Follow those principles, and you will build wealth. Ignore them, and you will work until you die. Your choice. Now, if you want more brutal honesty about wealth building, timeless principles that actually work instead of get-rich-quick garbage, subscribe to this channel. We don't promise easy. We don't promise fast. We promise truth.